In this video, we're going to talk about the second class of technical indicators called sentiment indicators. And these are called sentiment indicators. Why? What does sentiment mean? It sort of means whether the market is optimistic or pessimistic, or getting a sense of whether people think the market or the economy in general is going to do better or worse. And once again, these are technical indicators. So these are ones that must rely only on past price and volume information. Let's take a look at a couple of these. All right, so the first one we're going to talk about here is the trend statistic. What is the trend statistic? I'm going to need to show you the form. Formula, but let me just give you the philosophy behind it first. So it's the ratio of average volume in declining stocks. Let's remember what volume is. Volume is the number of shares that trade hands, basically the number of trades that go on. But the number of shares that trade hands in declining issues, what is that? Declining stocks that are going down. Okay? And you take that ratio to the average volume in advancing stocks that are going up. Okay, so it's the ratio in volume, how many shares traded hands in the stocks that were going down versus up. How do you actually calculate this? Okay, so you would go to a market diary again, and I'm going to show you one in a minute. I'll pull up a live one, but you just look up market diary. Wall Street Journal has a very, very good market diary, but you can find them on other websites. And there they will tell you across the different markets. This one has New York Stock Exchange, NASDAQ, AMX market. You look at those and you can get all the basic information that you need. So I have the number of stocks going up, the number of stocks going down. Right down here, I also have the volume, and that is what the trend statistic is about. It's about this volume. So it has the total volume, it has the volume in the stocks that were going up, and it has the volume in the stocks that were declining. Okay, what exactly is the trend statistic? How do you calculate it? Here's what it is. So think of the numerator and the denominator here as sort of being separate. And in the numerator, what do I calculate? I take the declining volume, that is the volume in the declining stocks. Where do I find that? That's right here. That's that 231 million number. And I divide it by what? The number of stocks that were going down. That's this number here. That's the 270. And so what does this give me? This gives me basically the average volume per stock. I'm dividing by the number of stocks, average volume of the declining stocks. Okay, so average volume of the declining stocks. And then what do I divide that by? I divide it by the same thing, but for the advancing stocks, the stocks that were going up. How do I calculate that? I take the total volume in the stocks that were advancing. That's right in there, and I divide it by the number of stocks that were advancing. So this down here, this is the average volume in advancing, okay? So why calculate this? What is this telling us? How is this trying to give us the sentiment of the market? Remember, sentiment meaning sort of trying to assign human characteristics to the market. Is it optimistic today? Is it pessimistic? Is it having a good day, having a bad day? That's what we mean by a sentiment indicator. So what this looks at is, I sort of think of it as, where's the action in the market? And it's measuring action by volume. Where's all the trading going on, right? That's what volume represents, where a lot of shares are trading hands. And so here what it does is it says, let's look at the stocks that are going down. Was there a lot of trading in the stocks that were going down? And let's compare that to the average volume in the stocks that were going up. And it's sort of like, where was the action? If there was more action in the stocks that were going down, then this ratio will actually be greater than 1. So what does that mean? That means sort of where was the volume, where was the action happening in the market? It was happening in the stocks that were going down. That's actually a pessimistic sign, a bad sign, or a bearish sign. So when the trend statistic is greater than 1, that's actually a negative sign. That's pessimistic. When it's less than 1, what does that mean? That means all the trading was going on in the stocks that were going up. That's actually a positive sign or an optimistic sign, okay? So that's something you need to remember and really watch out for here. The trend statistic is one that when it's greater than 1, that's actually pessimistic. And when it's less than 1, that's actually optimistic. If I were making it, I would have flipped that around, because it's nice to say, oh, if it's greater than 1, that should be a positive sign. If it's less than 1, that should be a negative sign. That's not the way the trend statistic works. It works the opposite. Okay, so try to remember that. Some of these go in the direction that you would expect. The trend statistic does not. When it's greater than 1, that's actually a negative sign. And when it's less than 1, that's a positive sign. I said I was going to jump over and show you this. Let's jump to a website here. I'm going to go to, here you go, the Wall Street Journal's Market Diary. Okay, so this is their, again, you can say diaries here. This is Wall Street Journal. They have a very, very complete market diary. And I'm going to scroll down, and I've got all the information that I would need to calculate the trend statistic. I have the number of advances, the number of declines. I've got the volume in the advances. I've got the volume in the declines and things like that, so I could calculate it. However, I look right here, and right here, they actually calculate it for me. Okay, so the trend statistic, also called the closing arm statistic. And what do I look at? Today, it was 1.2. It was positive. Is that bullish or bearish? Is that optimistic or pessimistic? And we remember, if it's greater than 1, that is a bearish sign. That is actually pessimistic. I look at yesterday. Okay, just yesterday it was less than 1. That would be an optimistic. And they're looking at it a week ago. That's very close to 1, so it's hard to tell, right? But it would be slightly on the optimistic side. Okay, so you see that this indicator, the Wall Street Journal, actually already calculates for you. And actually, if you scroll down to the bottom, they have a description of it here. Now, the formula looks a little bit different than the formula that I gave you. And you can go through the math and see that it's exactly the same. It's just, what you put in the numerator, what you put in the denominator, and because we have fractions in both, you can flip them around. Okay, but they do the same calculation right down here, right? They show you that calculation, and they say generally less than 1 indicates buying demand. Again, less than 1. What does that mean? All the action was in the stocks that were going up. That's that buying demand. That's the positive sign. And above 1 indicates selling pressure. That's sort of the negative or bearish sign. Okay, so that's the trend statistic. Let's move on to another sentiment indicator. This one is called the confidence index. It's trying to see how confident the market is generally about the economy. All right, how is it calculated? It's the ratio of 10 top-rated corporate bond yields. So it's what rate of return you would earn on 10 top-rated corporate bonds. What do I mean by top-rated corporate bonds? There's not really a risk of bankruptcy in any of these companies. So you're buying their debt, you're loaning them money, and they're going to be good for it. They're not going to go bankrupt. You're going to get your money back plus interest. So you look at the interest or the yield on that, and you compare it against 10 intermediate grade bond yields. Now, the intermediate grade ones, these are companies that aren't as solid. They're not on the brink of bankruptcy, but they're not as solid, okay? So in general, to get you to buy their bonds, to get you to loan money to them, they have to offer a higher yield. So this ratio, generally, the top-rated corporate bonds, their yields are going to be smaller than the intermediate grade corporate bonds. So this ratio is always going to be less than 1. That's no big deal. We don't look at that, but we know that it's always going to be less than 1. Okay, so it's always below 1. And what do we look at here? Generally, people look at the change in the confidence index, the change in this ratio. Here's my philosophy, okay? So before you read the bottom part, the idea, here's what I think the confidence index is really trying to capture, okay? It's these intermediate grade bonds, okay? So those are the ones that I said, they're not super solid companies. They're also not going bankrupt. And they're the ones that probably tell you what traders think about the future of the economy, right? If you think the economy is going to go fine, these companies are going to be okay, no problem, right? If you think the economy might go bad, then there might be a problem with these companies. The economy goes bad, they're in the middle, they might go toward that bankruptcy and they might go bad as well. So what I think this is trying to capture is it's really looking at those intermediate grade bonds and looking at the yields on them and trying to say, what does that tell me about what people think about the future of the economy? The economy is solid, no big deal. If the economy goes bad, these are the ones that are on the edge. Okay, so, but it has to benchmark those yields against something. right? So what does it benchmark them against? It benchmarks them against some top-rated corporate bond yield. So there's just basically a benchmarking going on there. And this one, thankfully, goes the right direction. What do I mean by that? The ratio is always below 1, but generally what people do is they look at whether this ratio is going up or down. And if it's going up, what does that mean? Well, investors are more confident about the economy, more confident about markets. If this ratio is going down in time, then they're less confident. They're getting more worried about the economy. Now, you can think this through in terms of which way the ratio should go, and that's what I put down here. When traders are optimistic about the economy, lower rated debt, that's the intermediate grade bonds, will require a lower premium and the ratio will be higher, and vice versa. So you really got to, at least I really have to think that through. But in general, just remember the confidence index, when it goes up, that's a good sign. That's optimistic, that's bullish. When it goes down, that's a bearish sign, that's pessimistic. This, I want to show you, is associated with a newspaper called Barron's. Barron's is another financial periodical. Let's go and find that. So if you look up Barron's, so here it is. And I went to their market lab, and they've got a lot of information in their market lab. So I actually did a search on the confidence index, and I came down, and this is actually related to bond prices, right, and bond yields. And so they have their high-rated corporate bonds right there, okay, and then they have the medium or the intermediate. They're telling you that, and here's the ratio. And they show you this ratio. Last week, 91. The previous week was about the same. A year ago, 79. What we would look at here is that the fact that this has gone up, the fact that it's gone up would say, hey, investors are more confident in the economy. That's a good sign. If we had seen it go down, we would say, hey, they're less confident. That's a bad sign. Okay? All right, so this is the confidence index. Let's move on to our next sentiment indicator. This one is called short interest, and it has to do with short selling. Okay, and in particular, it's the total number of shares currently sold short, usually for a specific stock. Now, if you remember short selling, what is short selling? You have to borrow shares and then you sell them. And what do you want to happen to the stock if you short sell? You think it's going to go down. That's why you short sell, okay? So this one says, hey, how many people have sold short, okay? And if you look at a stock and a lot of people have sold short, and then maybe you're like, wait a second, what do they know that I don't know? They're betting that it's going to go down. Maybe I should watch out about this, okay? So that is the notion of short interest. So when short interest is rising, this means what? Many people are shorting the stock and they believe the stock will fall. Let me show you this. Again, I'm going to jump over. I'm going to go to FinViz and I'm going to show you some different stocks and a sense of short interest. So I put in Apple here. You can see it's Apple right up there. So Apple, if you think about it, do you think a lot of people are betting against Apple, that Apple is going to go down? Let's look down and let's zoom in right here on the short float. Now, there are different ways that the short interest, see, they say short interest share, might be presented. So one is just called the short float, and that is what percentage of the shares that are out there have been sold short, okay? So this says less than 1% have been sold short. So that indicates that there's very little people betting against Apple. There's another way to look at this. There are different ways that people will represent it. Here's the short interest. This is the number of shares. However, most people don't look at that. Why? Because it depends on if the stock has issued a ton of shares or not, okay? So that's why you will tend to see, if they show you short interest directly, they will also present it in other ways, like short as a percentage of the float. Again, the float is the number of shares that have been issued. So this is how many shares, what percentage of the total number of shares have been sold short. So it's less than 1% here. Short ratio does it as a percentage of the average volume that's traded every day. That's another way to do it. But you can see here that it's very small. I'm going to be focusing on the short float. What percentage of shares have been sold short? Okay, so that's Apple, very small, less than 1%. I'm going to show you another one. So this is D-Wave Quantum. This is in quantum computing. Very interesting topic. But you can see this stock has gone up and down like crazy. And let's take a look here at short float. That is almost 20%. That means Almost 1 out of every 5 shares in this company have been sold short. So that indicates a lot of people are betting against this company, right? And so when you see that, and you see that going up, you're like, what do they know that I don't know? Okay, so that's sort of a sentiment indicator. A lot of people are very bearish on this stock, okay? So that is short interest. Now, there are actually different ways to use this. And so the standard way would be what? If there are a lot of people shorting, they're like, uh-oh, a lot of people are betting against this stock, maybe I should stay away. However, there are some people that actually like to buy stocks that have large short interest. Why is that? Okay, so depending on whether you believe the market is right or not, this can be either bearish, that would be the standard case, or some people, I said, actually look for these stocks and think that it can be bullish. Why is that? You might have heard the terminology of a short squeeze. So what does that mean? That means when many people are betting against the stock, what have they done? They have sold, right? And then what happens if they're wrong? The stock goes up, they're losing money, they're going to have to buy it back. What does that do to the price? That pushes it even higher and higher. More of those people who are short are losing money, they buy more, and you get sort of this feedback effect. And it can cause the price to spike very, very fast. And you tend to see that in stocks that are heavily shorted, okay? So that's the idea, that some people actually look for these stocks and actually go against the shorts, okay? That's actually, if you go back and you heard about GameStop a number of years ago, and it shot way, way up like crazy, that was a short squeeze. That was actually a company that many hedge funds had shorted, had huge short interest, and they got caught in a squeeze, meaning it started to go against them, and those hedge funds had to buy it. That pushes the price up higher, meaning they lose more, they have to buy back more, and boom, you get a very, very rapid rise in the stock. So that's sort of an interesting side note here on short interest. In general, if we're looking at short interest in this class, if it goes higher, sentiment, as a sentiment indicator, what does that mean? That means people have more of a bearish or negative sentiment on a stock. Okay, let's look here at our last sentiment indicator. This is the put-call ratio. Now, we haven't talked about options yet here, but I will give you the bare minimum to understand the put-call ratio. And what is this? It's the ratio of put options to call options outstanding on a stock. Again, we don't know puts and calls, but here's the basic idea behind it. A put option, okay, so this is a so-called derivative security. A put option gives people the option to sell. And the key thing is that it does well in a falling market, okay? So if people have bought a lot of put options, what do they think? They're worried that the market is going to drop, okay, and they think that it might fall. Call options, on the other hand, do well in rising markets. So if people have bought a lot of call options, they think the market is going to go up, okay? So by looking at those two, how many people have bought puts? They think it's going down. How many people bought calls? They think it's going up. Looking at that ratio, you can get a sense of which direction people are betting, okay? So this one, again, is sort of, in my opinion, is sort of backwards, like the trend statistic. Why? Because when it's high, that means a lot of people are betting that the market is going to go down, right? And when it's low, people are betting the market is going to go up. Again, I wish they had done it the other way. So remember which ones go the right directions and which one are sort of opposite. I'll show you this. This is associated with options, in particular CBOE, Chicago Board of Options Exchange. And you can plot this over time. And this plot here, the red is actually what the market has been doing. I think that's maybe S&P 500. Yeah, that's S&P 500. And then the blue line is this put-call index. Okay, so you can see very volatile. And you can see here, it tends to jump, like look over here, this was during COVID. It tends to jump quite a bit when the market starts going down. That's because people see the market start going down and they say, uh-oh, I think it's going to go further. And to bet that way, you can also use it as insurance. People buy put options. And so you can see that spiked really high, meaning sentiment was very, very negative. And then at other times when people are not worried about the market going down, it'll go low because what? People are buying more call options, and those are a bet that the market goes up. So as you see this go up and down, you can try to sort of get a broad sense of whether people are worried that the market is going to drop a lot or whether they're okay, they're not so worried, and that would be more positive sentiment. we see here at the end it's gone a bit lower. It's spiked a little bit, but it's gone a bit lower. So that seems to indicate that not a lot of people are worried about a big crash in the market. Otherwise, they would buy more of those put options. So what to remember about the put-call ratio? When the put-call ratio is greater than 1, that is actually negative sentiment. That's bearish. And when it's less than 1, that's actually bullish. People are more comfortable in betting the stock is going to go up. Okay, let's do a couple of problems. Those are the 4 sentiment indicators that we're covering here. Let's do a couple of problems to wrap up our quick look at technical analysis. So technical analysis focuses on what? Finding opportunities for risk-free investing, finding repeating trends and patterns in prices, changing prospects for earning growth of particular firms and industries, or forecasting technical regulatory changes. The answer here that most aligns with technical analysis is B, finding repeating trends and patterns in prices. Now, this is the way the book defines it. I think you should probably take a little broader definition of technical analysis, especially we saw some of the sentiment indicators. Are they really trying to find patterns in prices? However, in general, technical analysis, you should think of it as associated with that weak form of the efficient market hypothesis. So it's really any technique that exclusively uses price and volume information. And it can use it in any way that it wants. You can plot it, like with how moving averages. You can do calculations from it, like trend statistic and confidence index and things like that. But really, more broadly, technical analysis is any method that exclusively uses price and volume information. However, when you're looking at problems related to the book, they focus on this notion of looking at those past prices to find repeated trends and patterns. All right, which of the following is not a sentiment indicator? Okay, so you need to be able to classify an indicator, whether it's a sentiment indicator or not a sentiment indicator, whether it's trends in correction or not trends in correction. So let's take a look at these. Which one is not a sentiment indicator? Confidence index, short interest, odd lot trading, or the put-call ratio. And here, hopefully you recognize it as the one we didn't even hear about, odd lot trading. All the others we covered as a sentiment indicator. All right, let's do a calculation problem here, and then that'll wrap it up. Given the following data on bond yields, we're talking about bond yields. And what do we have? We have the yield on top-rated corporate bonds and then on intermediate-grade corporate bonds. And we have information from this year, those yields, and then last year. And what does it ask us to do? So number 1, calculate the confidence index this year and last year. So you might want to pause here, go do the calculation. I'm going to reveal the answer. Remember, the confidence index is actually just the ratio of the top-rated yield to the intermediate yield. So you take that ratio. So this year, what is it? It's 9.5 divided by 12. Just take that ratio. So it's 0.79. Last year, it was what? 10 divided by 11.5, and that's 0.869. So we look at those two. So that's the first thing, just calculate it. Here's the second part of the question. So given we're using the confidence index, is confidence increasing or decreasing? So we need to be able to interpret it. All right, so think about the answer, and here's the answer. It is decreasing. Why is that? Because last year it was almost 0.87, now it has dropped to 0.79. That ratio is going down, and for the confidence index, when the ratio is going down, that means confidence is decreasing. All right, that's it for our quick look at technical analysis.